Good morning, everyone. There are two screens here. I hope screens are visible to all. Screens are visible to all, sir? So, sir, today our objective is we are going to try to understand how to read financial statements. English is comfortable with everyone, sir? A bit of Hindi also in between is comfortable? Okay, sir, what I make to understand is that we've just started our duty. So the presentations which I have made, they are very advanced and very technical also. But I am going to make it very simple and elementary, and I will speak in a very simple way. Okay, please feel free to ask me as many questions. Our objective today is to get as much out of the session. We have one more session tomorrow as well. Today I have two sessions from 10 to 12:45. Tomorrow also I have two sessions from 10 to 12:45. So I have been made to understand that many of us are also from different backgrounds apart from commerce. Means some of us are from art, some of us are from science, right? So please feel free to ask me questions, no problem. I'll make it as simple as possible. This presentation, however, it is more than 250 slides. So it has a very, very comprehensive coverage of all the things which we need to understand how to read financial records, okay, from GST point of view. I will keep less of accounting, more of GST, so that everyone can, benefit from that, right? So this is a brief about me. I'm a chartered accountant. I'm a company secretary also. I have done my post-qualification degree in law. I'm a registered valuer. I have done my master's in applied finance from Singapore Management University. I am a diploma in information systems audit from ICAI, that is the Institute of Chartered Accountants of India. I was all India ranked second in that. Then I am a diploma holder in international taxation. I am also an enrolled agent with the IRS USA and BCom graduate. This is a brief about my firm, R.Tulsian and Company. This is my my visiting card. I've got a pack of my visiting cards here also. So we can definitely connect later also in case you have any query. So we can definitely connect after the session also by phone, WhatsApp, anything. I'm free to available to help. Right? Now today, sir, what we are going to try to cover is elements of profit and loss account, elements of trial balance, what all areas in a profit and loss account or income statement which we say in a company or in any entity where we need to see from GST perspective. Not just from accounting perspective, not from any financial perspective, but from GST perspective. If any financial statement means profit and loss account is given to you during GST audit, during your investigations, or if you seek such a document during even scrutiny, right, which is not allowed, but during scrutiny you have the right to, you can ask for the further documents, but usually for scrutiny, GST scrutiny, that is issuing of ASMT 10 and all of those things, usually the documents or the data which we already have, GST 2A, 2B, 1, 3B, 9, all of those, on the basis of that only we issue the ASMT 10. But we are going to see elements and we will see practically. See, this is a bird's eye view of what all important documents are there when we say I want to read financial records, I want to read financial statements. So we have balance sheet, obviously we all know as on a given date, we have the list of all the assets of the company, list of all the liabilities of the company. We have profit and loss account which has the revenue, which has all the expenses, direct expenses, indirect expenses, net profit, all of those things. We have cash flow statement which tells us the areas where cash is going in, cash is coming in, going out and coming in. Then we have notes to financial statements, extremely important. Whenever we have 1 or 2 pages of summarized income statement, PL account, PL statement or balance sheet, there are 20-30 pages of notes to accounts only. We need to see every notes to account. One note to account is for revenue, second note to account is for direct expenses, third note to account. So these are detailed information, extremely important for us to read, understand how to read those. We have director's report. In a company, we have a director's report also attached to the audited financial statement, wherein the director says that, we are planning to open one power plant next year, we are planning to adopt digital marketing, we are planning to have an investment of 5 crore rupees over the next year. So we will understand what is the future plans of the particular management, right? An independent auditor's report, as we are aware that every company has to be audited by a chartered accountant, right? Even if it has zero turnover, statutory auditor, right? He has to issue a statutory audit report. So, and for tax audit also, are we aware what tax audit is? If I have turnover more than 1 crore. So, a tax auditor under Income Tax Act, 44AB, Section 44AB of Income Tax Act, he has to audit the financial records from the perspective of Income Tax Act, not GST, Income Tax Act, right? So, these are few of the documents which we are going to see, right, from GST perspective. Right now, we will start with profit and loss instance. See, these are the bird's eye view areas where GST, some way or the other, there is an impact. GST has an impact on revenue from operations, we know. If anything we sell, we have to collect GST at the rate given in the HSN, right? And we have to make payment to the government. That is revenue from operation. We will go into detail for each. Other income, segment reporting, employee benefit expenses, conveyance, and all of these things which we are going to go one by one in detail. Let us first understand this is an extract of an income statement. Means this is profit and loss account, just the revenue part. I want everyone to go through this. These are 4-5 items. Now, what is the first thing which comes to our mind from GST perspective? We have first sale. So first we see bulk drugs and drugs intermediaries, means it's a pharmaceutical company, right? In other income, other operating income, we see duty drawback, we see export incentive on MEIS scheme. Like if we export, so we have certain incentives which the DGFT they give us, right? That whenever we import, so we have to pay 18%, 12% IGST. So these MEIS, merchandise export incentive scheme, all of these are basically incentives for us. If we are going to export certain items and when we are going to import, so we can have the benefit of these incentive scheme. Means, for example, if I export some goods and if I have to pay 12% IGST, so I have to pay it out of my pocket, I can claim input then, right? But this incentive scheme, in case if we have this incentive scheme, we will get 3% off on payment of IGST on the FOB value, right? So these are, if I use those imported material to make goods to export it further. So if I am an exporter, if I am importing, I will get some benefits on import, right? So these are export. So seeing this particular income statement, what are the first thoughts which come to our mind from the GST perspective? First thought which comes is, acha, there is some export something written. So does the company do export? If the company does export, from a GST officer perspective, what are the areas where I need to focus? What are the areas where I need to scrutinize? What are the areas where I need to ensure compliance has been done from the perspective of export in GST? That is first thing which comes to my mind. Acha, there is some export incentive also. Okay. So under merchandise export incentive scheme, MEIS, SEIS, FMS, there are certain schemes of benefits. So I get that particular scheme, I can sell it in the market. If DGFT has given me 3% off this particular scrip, duty credit scrip it is called. If I sell it in the market, I can sell it in the market. It is a commodity. If I sell it in the market, what is the implication of GST on that, right? Also, it is a pharmaceutical company. So, acha, for pharmaceutical company, is there any specific circular? If my medicines, they get expired and I have to give it back to the retailer or the manufacturer. So, in that particular case, is there any specific circular which will regulate my sending back the goods? Means, I have to issue a debit note, the retailer or manufacturer who has sold me has to issue a credit note, or what is the way that we are going to send the goods back? So, these are first few things which come to our mind, okay, when we see this particular PL. Now see, these are the questions which I have raised. When we see that particular profit and loss account, does the company do exports? Yes, the company must be doing exports because it has some export incentives. So in this sale, there would be 10, 20, 30, 40, 50% of export sale also. It is not a breakup. Domestic sale is also there, export sale is also there. From GST perspective, we need to see, acha, he has a certain sale on export, so he has some accumulated input tax credit because he is exporting, he may be exporting without payment of IGST. There are two ways of exporting, we may be aware. First is with payment of IGST, second is under LUT bond without payment of IGST. We may be aware of that, right? In case if this pharmaceutical company exports without payment of IGST under LUT, letter of undertaking or bond, so in that particular case, if he does not have to pay any GST on sale, so when he has paid GST on purchase of these medicines, so input tax credit has accumulated. He cannot set off because there is no tax on sale only, right? Because it is export without IGST. So how do we get refund? My capital is blocked in the input tax credit accumulated. How do I get the refund of the input tax credit? Right, aware? Right? Now, whether there is a mechanism, section 54 is there, rule 89 is there, rule 96 is there under GST Act, so that we can get refund. So, in this particular case, has the GST refund been correctly claimed? Have we applied for GST refund properly? Under rule 89 means where export has been done without payment of IGST under LUT bond. My second question. Third question is whether company has claimed GST refund which is not eligible to them. I will come to this particular point. Acha, whenever we make any export, there is one rule we are aware under section 16, right? What is under section 54? What is that? Whenever invoice is issued for export, we need to export within 3 months. Why is there 3 months? Why is not 1 month? 3 months because there would be time so as we engage the shipping line, we get a berth, we park the particular vehicle, we do loading, so it takes time. But if it is more than 3 months, then we will not be allowed to export. There will be a penalty. Whether the same has been done in this case. Now, for sale returns, as I said, for pharmaceutical companies, there is specific circular. When we do expired medicines return, if expired medicines are returned, there is a specific circular for that. So, whether that circular has been followed. Merchant export transactions. What does that mean? Means that if I have purchased from my supplier at 0.1% concessional rate rather than 18%, 12%, the normal rate for medicine may be 5%, 12%, 18%. But I have availed a concessional benefit wherein I have paid only 0.1% to my supplier. I have got those particular medicines at concessional rate following a particular benefit of a notification 40/2017. So whether I followed all of those things, right? So let us first understand wherein we saw this particular export incentive. So this is a sale of duty credit scrips, as I told you, MEIS, SEIS, those benefits are when we import and then when we use that particular imported material to further export. So government gives me a duty credit script that when you are importing, you get 3% discount on the import duty, right? So I don't want to use that, I want to sell it. Now as per GST law, if I sell that duty credit script, we may be aware that it is selling of duty credit scripts is an exempted supply, it is not a taxable supply. We must be aware of that, right? In case if we don't, what is exempted supply means? By any duty notification, it is exempted. No tax is to be paid on that. But second thought which should come to our mind whenever we are selling something which is exempted is that the input tax credit in relation to that particular sale, we will not get the input. If we are going to sell something wherein we are not paying tax, if we are availing input, we have to reverse that naturally, right? Otherwise it will be a loss to the government. So in this particular case, that is first thought which should come to our mind. Second thought, what should it come to our mind? There is some rule 42, rule 43 of CGST rules. What does that say? That says that if total sale is 100 rupees, exempted sale is 10 rupees. So 10 divided by 100, total sale percentage, what is there? I have exempted sale, 10%. So 10% of the common credit which is there. What is common credit? Common credit means credit which I have utilized or I can avail for both taxable supply as well as exempted supply. Means rent of this place, my factory, I am producing exempted supply also and taxable supply also. So my rent of this place becomes a common credit for both taxable as well as exempted. So 10% of common credit means this rent is pertaining to exempted supply. So whether the particular person will get input of 10% or not, or he has to reverse. He has to reverse naturally by law, by logic also. So that reversal, it is mentioned in rule 42, 43. Now there is a benefit in case of sale of duty credit scrips. That is, we don't need to consider the sale of duty credit scrips. If 100 rupees I have sold and I have got 100 rupees of duty credit scrips, if I sell it in the market, that 100 rupees is not going to go in the numerator divided by total sale to calculate the reversal. No requirement. There is a benefit to the taxpayer. There is no reversal of input tax credit required in case of sale of exempted supply exception duty credit script, right? So this should be there in our mind that acha, if I am selling some export incentive which is duty credit script, MEIS, SEIS, FMS, in respect to that, that is an exempted supply, but in respect to that, I do not have to reverse my input tax credit, means the taxpayer. It's very important for us to know, right? Whether this has been followed or not. The department cannot force, right? Now let us see this particular, now as I was mentioning, let us see this. This is an attachment from a GST Scrutiny Notice, right? ASMT 10 comes in, GST Scrutiny under Section 61. Along with that, there is a detailed discrepancy sheet. In detailed discrepancy sheet, let us not focus here, let us focus here only. See, they have caught, they are saying that, sir, your exempted sale, exempted nil rated, exempted sale is 19,000. So your total sale is 11 crore 67 lakh. So 19,000 divided by 11 crore 67 lakh is 0.02% of sale. So they are saying the common credit which you have claimed in GSTR 3B is this IGST 1 crore 58 lakh, CGST 33 lakh 89,000, like that. Now they are saying 0.02% of this you need to reverse, because 19,000 rupees is your exempted sale. But I am saying duty credit scripts will be exempted sale, but this reversal is not required. This is what I am saying. So this is important for us to understand, very important for us to understand. Whenever we are seeing some duty credit script, means exporter balance sheet PL, we need to first see acha exporter, oh refund, oh acha whether 90 days he has exported the goods actually after the date of invoice, oh acha. Second thing, whether he has any duty credit scripts, if he has sold it, exempted supply, no problem, but no need of reversal. You cannot catch the collar of the taxpayer saying, oh acha exempted, so 42, 43 do reversal of input. No, for sale of duty credit scripts not required. Now this is, we must be aware that there was 53rd GST Council meeting, right? We know the GST Council is the apex body for policy formulation for GST, right? That happened on 22nd of June 2024, last month. And budget was presented, Finance Bill 2024, right? When was that presented? It was presented on 23rd of July, right? There were many changes which were brought about. One important change in respect to this balance sheet, this PL which we are seeing, export related. A change has come. What is the change? Sir, I have sold, let us see this. I have sold 1 crore 31 lakh 64,000, whatever, 13 crore 16 lakh 46,000, something, whatever it is. I have sold this much amount. In that, for example, 50% is sale, export sale, I have sold. Now what happens is, sir, in case of rate revision, for example, I am selling the medicines at 100 rupees. Later on I come to know that this is not 100 rupees, it should be 120 rupees. So 20 rupees further I have to export. If I am exporting, how will I do? I will issue a debit note. Right? Now when I am issuing a debit note of 20 rupees, I am going to export with payment of IGST, for example. So 5% on 20 rupees is how much? 1 rupee. So 1 rupee I will pay and I will export. Sir, will I get the refund of this 1 rupee on the debit note which I have done further sale of? By automated refund. We are aware there are two types of refund which we can apply. One is under LUT bond, where accumulated input tax credit we calculate and we apply under Rule 89. Second is what? Second is automated refund. We don't need any LUT bond, nothing. We are just going to sell. We are going to, on ICE gate, they are going to see a shipping bill. They are going to see a GSTR 1, GSTR 3B. They are going to match the sale amounts. If they match, then they will automatically issue refund. I am going under automated refund. So on debit note of 20 rupees, for further upward revision, 20 rupees, I have raised a debit note, 1 rupee I have paid tax to the government. So I should be automatically, within 1 month, I should be getting this 1 rupee as I would have got on 100 rupees original export with payment of IGST. But this was not happening, because this was not happening. The reason being is that when you sell your original bill, there is your shipping bill is there, your commercial invoice is there, 100 rupees. GSTR 1 is there, 3B is there. All of those things match on ICE gate, 100 everywhere. And you get automated refund of 18 rupees. Right? But when you are issuing a debit note 1 month later saying, oh acha, I missed out something, I want to further export, there is no consignment, there is no shipping bill, there is no bill of lading, because that is already gone. 1 month later I am just upward revision of price, I am doing that. So in respect of that, when I am making payment of 1 rupee, there is no automated system that will trigger for that refund of 1 rupee, right? So this particular compliance, they are giving us a benefit. Now they are saying that 1 rupee is blocked because of upward revision of price of export by issuing of debit note, which is not being automatically linked with ICE gate. So no problem, I can apply for refund under what? Under Rule 89, which is accumulated input tax credit. That is, file an RFD 01 and then within 60 days you get refund, right? So we need to see, okay, whether there is, when we see this particular PL of an exporter, we should see, acha, in sale there is any debit note. If there is any debit note, is it related to export? If it is related to export, is the refund, has he applied under automated refund filing? Oh, acha, if he has, then has he filed any RFD 01 to get that 1 rupee back? Are you trying to being able to link? So these are few things which we need to understand from exporter point of view. From exporter point of view, one more thing, when we see the balance sheet, so when we see the PL, we are going to naturally think as an officer that, acha, he must have applied for refund. Let me see if he has applied for refund under RFD 01, which is accumulated input tax credit, that one. So under Rule 89. Now what is the formula under Rule 89? We must be aware of this. The formula is export value, as much I have exported, numerator, divided by total adjusted turnover into the input tax credit which I have claimed during the period in GSTR 3B, which is appearing in 2B, right? Now what was happening is, if numerator amount, I have sold 100 rupees of export, denominator is 100 rupees export plus 200 rupees domestic, 300 rupees. So 100 export divided by 300 total adjusted turnover, 1/3. So I am going to get the refund of accumulated input tax credit of 1/3 proportion, because in that input tax credit I have input for domestic supply also, for export supply also, right? So the numerator should have value of 100. That should be FOB value, free on board value. Are we aware there are two types of values, free on board, CIF? Are we aware of this? Free on board, CIF, cost inclusive freight. So free on board is where the exporter, which is me, an Indian, I am going to separately engage a shipping line. I am going to pay separately. CIF is when my foreign where I am exporting, I am going to, in CIF, I am going to the Indian exporter. He is going to pay the foreign shipping line also, everything. So that will be cumulative value. Free on board is when the foreign importer, he is going to engage a shipping line. So what I am trying to say, the numerator and denominator should have the same export value, 100 rupees in numerator also, in denominator 100 rupees. So in numerator it should be FOB value, denominator it should be FOB value, right? Now if we are seeing the PL of an exporter company, if we are exporting, what are we exporting for? Foreign reserves to come into India, right? If foreign reserves exchange, they are coming into India, there should be a time limit. So there is a time limit of 9 months under FEMA, Foreign Exchange Management Act. If the foreign reserves, foreign exchange does not come within 9 months from the date of export, then what do we have to do? We have to return the refund amount along with applicable interest. In case of export of goods, in case of export of service, what is it? It is 1 year from the date of invoice. So when, as a department officer, I am going to see, acha, this is a PL of an exporter company. Oh, he is exported. Oh, foreign exchange has come. Oh, has it come within 9 months from the date of export? Date of export is when the vessel leaves India. And if there is any export of service, whether foreign exchange, USD, dollar, pound, all of that has come within 1 year or not. If not, if I have applied for any refund, return it with interest. Now, as I said, that particular PL account, we saw it was of a pharmaceutical company. Now, there is a specific circular 7246/2018 which says that in case if I have bought some medicine, it has expired within 1 year. Expired medicine, I want to return it back. So when I sell it, it goes in sale. That is fine. But when I am returning, as per this circular, there are two treatments which the pharmaceutical company can do. First treatment, it can issue a debit note, right? And the retailer or manufacturer who has sold me last year, he can issue a credit note. As simple as that, right? Or the second is that when I am returning the goods back to the manufacturer or the retailer, I can issue a new fresh sale invoice also. When I am returning back, it is wrong in a way, but this circular says if you are returning back the goods, you can show that you are selling it to them. So they can claim input and you have to pay tax, output tax. So we need to see that different businesses have different circulars, different business types. So since we had picked up a pharmaceutical company and that to an exporter, these were few of the things which we need to understand. Now, revenue. See, for revenue, sir, let us try to understand first concept. There is one PAN. We know what is PAN, permanent account number. Okay, that is associated to your tax number for an income tax file. So if I have a particular company, this company's name is Pharmaceutical Private Limited. Pharmaceutical Private Limited has one PAN all over India. Naturally, it will file only one ITR, right? But it operates in West Bengal, Gujarat, Maharashtra, Karnataka, Odisha, in 5-6 states. GST law says as many states you are operating in, you have to get as many GST registrations. We must be aware of that, right? Now, if we have multiple GST registrations in 5 states, we have to do GST compliance 5x, 5 times. But income tax compliance is only once. That is ITR filing, right? So when this Pharmaceutical Private Limited is having an audit, income tax audit, statutory audit, whatever, that audit will be of 5 different entities or one consolidated balance sheet. One consolidated balance sheet, right? The company's PL and balance sheet all over India, it will have one consolidated figure of sale, one consolidated figure of assets and liabilities. So one audit report, statutory audit report and tax audit report. This is statutory audit report under Companies Act 2013 is required, as I told you. If it is a company, mandatory. Zero turnover also, loss also mandatory by a chartered accountant. Tax audit under Income Tax Act 1961. Turnover more than 1 crore. So you have to, the tax auditor, chartered accountant, he has to audit. So when they are auditing, there is an audited financial statement which contains, what does it contain? Consolidated turnover of the entire company. Company has 7-8 branches across 7-8 states. So turnover will be 1,000 crores, for example, all over India. That will go in your audited financial statement. But when I am filing 9C. This turnover will be all over India. This is 9C, GST and 9C. Are we aware what is GST and 9C? GST and 9 is annual return. GST and 9C is reconciliation statement. So that we need to file when? Next year's 31st of December. Means for 23-24, the last date of filing GST and 9 annual return, GST and 9C reconciliation statement. For 23-24 is 31st of December 2024. Exactly. Now this is one extract of 9C. Sir, what am I saying? 26 crores 70 lakh 42,000 is turnover all over India across 5-6 different branches. But now this is from the audited financial statement, right? But this turnover which comes in, turnover as declared in annual return, this. Now let us understand, 9C we have to file only one for Pharmaceutical Private Limited or 5-6 for each state registration. Can anyone answer this? 9C we have to file for each GST registration in every 5-6 state or only one as per the company? As many, right? Because if we have 6-7 GST registrations, for each GST registration there is a state turnover, means there is a turnover for that GST registration. It does not matter what is Maharashtra GSTN or pharmaceutical company earning in West Bengal. West Bengal GST registration, if it's earning 500 crores, so they have to file, West Bengal GST registration has to file 1919C. Maharashtra has to file 199C. Bihar has to file 1199C. So multiple 99C is there. This is for West Bengal. But this is pan-India turnover and this is only West Bengal turnover. So in between, I need to remove the turnover of the other states, right? So 9C, what does 9C says? 9C says that this particular turnover amount, do not put of India. Do not put of India. Take the audited financial statement. Out there would be details of segment reporting. Segment reporting. West Bengal turnover, Maharashtra turnover, Bihar turnover, Odisha turnover. For GST and 9C of West Bengal, GST and 9 of West Bengal, only report the turnover of West Bengal GST registration. Right? So this turnover, it will not match with my audited financial statement of entire India of that company. This will only be the turnover of the West Bengal GST registration, for which we are filing GST and 99C now. Right? Are we understanding this concept? So the first point, operations in multiple states. PAN is one, GST registration multiple. Right? Multiple registration within the same state. Sir, within the same state, can we have multiple registrations? I am a footwear brand. I am also into digital marketing. I am also into, for example, catering. There are 3 different verticals, business verticals in West Bengal itself. Is it mandatory now for me to acquire 3 different registrations, GST registration, if I am operating within the same state for each different GST, each business vertical? Is it mandatory now or not? Earlier it was mandatory, 2-3 years earlier. Now you can operate in one GSTN of West Bengal 3 different, 4 different, 5 different business verticals. But ease of doing business will be very much hampered, because in one GST registration you are having input of from footwear business. In the same GST registration you are having input from your catering business, from your digital media business. So it will all be cooked up. You will not be able to differentiate. So it is recommended you take different registration within the same state for each vertical, but not mandatory. Okay. What is mandatory? If Pharmaceutical Private Limited had one business establishment in an SEZ zone. Are we aware of SEZ? Special Economic Zone. What is Special Economic Zone? Means there are backward areas in India where the government notifies that from this kilometer to this kilometer, since it is backward, I want to develop infrastructure, I want to get business. So next 10 years tax holiday under Income Tax Act means next 10 years, if you set up business within the next 2 years, you don't have to pay a single penny of income tax for the next 10 years. Which company will not go there? Every company would want to go there, want to save tax of 10 years, that's in crores. So slowly that backward area becomes a industrialized area with all infrastructure, everything. So that becomes an SEZ, Special Economic Zone. So if any registration is in Special Economic Zone and in non-Special Economic Zone, means DTA, Domestic Tariff Area, which is not a Special Economic Zone, means any other place in India, there is mandatory 2 different GST registrations we have to take. Very important for us to understand. So if a company balance sheet we are seeing, he has an establishment from SEZ. Also he has an establishment in non-SEZ. So there should be 2 different GST registrations. Balance sheet will be 1. Registrations will be 2. Important for us to understand that. Now sir, supply between GST and of same PAN. I want to transfer pharmaceutical medicines from West Bengal branch to Maharashtra branch. I want to export. I want to export from Maharashtra. I don't want to export from Port Trust here. Or my order is from Maharashtra. So what will I do? I have medicine of, for example, 1,000 rupees kept in my godown in West Bengal. I am going to send it to my Maharashtra branch. GST and registration of West Bengal is different. Maharashtra is different, as I told you. Every state, even if you do any operation there, you need to have a GST registration separate. So, but PAN is same. PAN is same, 2 different GST registration. So what are these called? Distinct persons. In GST it is called distinct persons under section 25. And distinct person means what? That they are under the same PAN but 2 different states or 2 different GST registration in the same state. So what is the concept? Concept is if I am sending medicines from West Bengal to Maharashtra. So when I am transporting, do I need to issue a tax invoice? Is it a sale? Or do I just send it across as a delivery challan? Means no sale. I am just sending it from one branch to the other. What do you say, sirs, madams? Stock transfer, delivery challan or sale? We need to show it as sale. Sir, as per accountancy, you are absolutely correct. It is as per accountancy in the same balance sheet, how can I sell from one branch to the other? There is no sale because money from one pocket is going to the other, right? But as per GST, it is entirely different. Absolutely opposite. In GST, if I am selling from one branch to the other branch, they have two different GST registration minded. Different states mandatory. In the same state also optional. For different verticals, optional. But if I am doing stock transfer from one GST registration to the other under the same PAN, sir, I have to issue a tax invoice. That is a sale for me. GST sale. Now, sir, when I, in my PL, in my profit and loss, whether this sale will be recorded? Of course not. How can it be recorded? Because I cannot sell to myself. Audit report or financial statements are made for entire company all over India. So if I am selling from West Bengal, what will be the entry? If I am selling from West Bengal, in West Bengal, I will not say West Bengal balance sheet, West Bengal PL. There is nothing called West Bengal balance sheet, West Bengal PL. Pharmaceutical Private Limited balance sheet PL. I can say financial records of West Bengal GSTN, Maharashtra GSTN. Balance sheet and PL is of Pharmaceutical Private Limited. It cannot be of West Bengal. It cannot be of Maharashtra. So if I am selling from West Bengal GSTN to Maharashtra, what is happening is I am registering sale in West Bengal, but I am registering equivalent purchase 100 rupees, sale in West Bengal, 100 rupees, purchase in Maharashtra. I am collecting 18 rupees, 18% on 100 rupees from Maharashtra unit. West Bengal is collecting, he is paying it to the government. And Maharashtra unit is availing that input of 18 rupees. This concept is clear, right? Now when I am consolidating all of these figures into one sale figure for my audit report, for my balance sheet, for my PL, for the entire company, which is there for income tax act. So sale of 100 rupees, Pharmaceutical Private Limited, purchase of 100 rupees, Pharmaceutical Private Limited, it gets cancelled, nullified, compensating effect. Where is the sale? There is no sale of inter-branch transfer between GST and registrations in the balance sheet or in PL, no record. So when we are seeing what are we seeing? When we are seeing the final sale figure in our balance sheet, in our PL, there is no sale of inter-branch transfer. But for GST registrations, different. Sale is there, purchase is there in Maharashtra, sale is there in West Bengal. So when we are consolidating all of these, we need to cancel out inter-branch transfers. Right? This is an extremely important concept when we are reading the PL of a company. Company is whole as per India, but we need to see, it is a national company. There are 5 GST registrations. Okay, so what do I need to see? I need to see whether e-way bills have been issued. Because interstate e-way bill, 50,000 rupees more of invoice value. If invoice value is more than 50,000 rupees, we know that we need to issue an e-way bill. So e-way bill record will be there, but sale record will not be there in balance sheet. Sale record will be there in your particular financial record of West Bengal unit. So you need to be careful when we are comparing the figure of your balance sheet with this individual GSTNs. Now let us understand. Now let us, for example, take Pharmaceutical Private Limited as a whole, India. Total turnover is 26 crores 70 lakhs 42,000. This is as per audited financial statement. Means entire India audited financial statement, not West Bengal unit of Maharashtra. Now what is happening is the GST turnover is 27 crore 8 lakh 60,000. But your accounting turnover from your audit report is 26 crore 70 lakh. There is a difference of what? 38 lakh 17,000, which I am putting. Now sir, there difference means, first of all, the GST tax officer, which means ourselves, we are going to see difference. So he is under-reporting in audit report, he is over-reporting in GST, and so no problem as such, there may not be any loss of revenue, but why is there a difference? We are always want to reconcile the difference. So sir, all the differences do not necessarily mean that it is a lapse or a discrepancy. Let us understand. Accounting is followed by Ind AS. Accounting is followed by Indian GAAP, generally accepted accounting principles, GAAP, that is accounting standards. And Ind AS is accounting standards for big companies, listed companies or after a particular threshold. They have different policies of recording or whatever, revenue. But GST has its own law for recording its revenue, right? There has to be some difference. We need to understand those differences, right? Now, what is the first difference? Sir, accounting policy difference. insurance and incidental charges received from customer. Now what is happening, sir? When I am selling some goods, let us understand this concept. 100 rupees goods value, medicines. Loading charge 5 rupees. Insurance charge 2 rupees. 100 plus 5 rupees, what? Loading charge. 3 rupees, your insurance charge. 100 plus 5 plus 3, 108 rupees. And 5% on 108 rupees. That is my total invoice. I will give it to my buyer. Now when I will record that particular, on what amount will I collect GST? 108. Because as per section 15 valuation, which is the what we say, the supply. What is the supply? The definition of supply. Section 15 valuation. It says all sorts of expenditure incidental to a sale has to be recorded in the same invoice and GST has to be collected in that. Sir, you are selling, loading won't be there in the truck. How will you sell? If there is no insurance, how will you sell? So that is, if it is a part of the same invoice value, so a same invoice, it will be a part of the transaction value. 100 plus 5 plus 3, incidental to the sale. So 108 becomes my sale as per GST. GST turnover is 108 rupees, right? Because I have collected GST 5% on that. Now accounting, in my books of accounts, how will I record it? I will record 100 rupees in my top line. Like for example, let's see this only. 100 rupees medicine value, I will record here. Sales, 100 rupees. In other income, I will record here insurance. In other income, I will record loading charges. I do not take other income. In my 9C, I take only the top line. Sorry, what's happened? Yeah. So, in my top line, it will only be 100. In my other income will be 5 rupees or 8 rupees. That is my income I have collected, but I will not record it in my sale of medicines. Sale of medicines is my main product. Why will I record loading charges and all those? I will record it in other income. Other income will not come in my top line in GST and 9C when I am comparing with GST turnover. Or second accounting treatment. Sir, loading charges. Do I have my own labor? Do I have my own truck? No. I am hiring a truck. I am paying to the labor. If I am paying to the labor 1.5 rupees, say, and I am collecting 5 rupees. So what will I do? There is also in PL, we have expenses debit side. So in debit side, if my total expenditure which I have paid on loading is 100 rupees for the entire year, I have collected from the customer, say for example, 90 rupees. So 90 rupees ideally should be in the sales. Because it is a part of GST in the same invoice. I have collected GST, but I will neither record it in sales, I will neither record it in income, other income. I will set it off against 100 rupees which is showing in my debit side. Means 100 rupees expenditure loading charges in PL debit side minus 90 rupees which I have collected from my customer. So 10 rupees net expenditure I will show in my PL. I can show that also. Law accounting standard allows me that also. So 90 rupees is disappeared from PL statement only. It has been set off against expenditure. So when I am reconciling this, 26 crore 70 lakh 42,000. This is as per the audited financial statement. Does this have that 5 rupees this collected of loading charges? No. Because I have not reported in my top line sales. I have not reported in my other income. Other income does not even come here. This is the top line sale. Right? So, what do I have to do? I am going to, this will be the difference. Because in GST turnover that 5 rupees is there. I have mentioned it in my tax invoice and I have collected GST on that. So, it is a 5 rupees will be a part. That's why this 27 crores higher. 24 crores, 26 crores lower. 38 lakh 17,000 is apparently underreported in the financial statement, in the PL. But it has not been shown in sales, it has been set off against expense. So here I am reconciling, saying that sir, 23 lakh 23,000, I have shown these insurance incidental charges as other income. Other income does not come on top. 14 lakh 93,000 of what? Loading charges. I have set off against, separately adjusted against other expenses, not included in in PL account, in sales side. So these are few of the differences which we see. Now we may be aware of e-way bills, right? Sir, let us recall the e-way bill provision for West Bengal. First provision for e-way bill, if I am going to send out goods, invoice value more than 1 lakh rupees. What is invoice value? Taxable value of the goods plus CGST, SGST. Total is the invoice value, right? So 100 rupees of pharmaceutical plus 18 rupees of GST. 118 rupees is the invoice value. If this invoice value is more than 1 lakh rupees, and even if there is intrastate, means from Baliganj to Havla in West Bengal, from Durgapur to Kolkata, if the invoice value of pharmaceuticals more than 1 lakh, then e-way bill has to be generated. E-way bill, who can generate? Consigner, I am the seller, I can generate. Consignee, the buyer, he can also generate. And the transporter can also generate, right? Second rule of e-way bill in West Bengal, if there is intrastate movement, intrastate we've already discussed, 1 lakh, interstate movement, that is invoice value if it is more than 50,000 rupees. If I am sending pharmaceutical consignment from Bengal to Jharkhand and my invoice value of pharmaceutical consignment is more than 50,000, 60,000 rupees, I have to generate an e-way bill. Third, for job working. Job working means what? I am a textile manufacturer. I have given my blanket or textile sari to a job worker. He will do embroidery, he will do printing, he will do some pressing exercise on that, dyeing, coloring, and he will give it back to me. So when I am sending the goods to my job worker, do I need to issue any e-way bill in West Bengal? In West Bengal I am talking about. No. This was revoked earlier, if you guys would be aware, in November 2023, but it was again restored from effect from 1st of December 2023. So currently for job working any amount, no e-way bill, right? Now sir, this is one thing. Second thing, sir, let me ask you a question. In all cases of sale or in all cases of outward supply, do we need to issue an e-way bill? No. If it is less than 50,000 interstate, less than 1 lakh interstate, we don't need to. Job work, so as it is, we don't record sale, but these two we don't need to. Exceptions are there. Sale is there, e-way bill is not generated. Sir, is there any case where e-way bill is generated, but your sale is not recorded? Is there any case like that? Is there any case like that? For interstate job working. Intrastate, West Bengal exempt. Interstate, more than 50,000 we have to. But sale is not there. I am just sending it for job working. Job working does not mean sale. Job working matlab ki I have sent it to a person who is doing some exercise on that. He will give it back to me, then I will sell. Right? But e-way bill is generated there is no sale. So there are instances where sale is there, e-way bill is not required. There are cases where there is no sale, e-way bill is required. Plus minus, plus minus. So we need to do a reconciliation. Now this is a notice. Sir, this is not my working or something. This is a notice of a client. ASMT 10 attachment. What is it saying? It is taking highest of all of these sales recorded in multiple places. GSTR1 sale is this, 9 sale is this, 9C sale is this, e-way bill is this, 3B is this. Whichever is the highest, I am going to take and compare it with my 3B sale. Right? So e-way bill, if you were to see, as per e-way bill generated, e-way bill data is saying sale is 35,83,000. I have reported sale in 3B 35,32,000, 83,000, 32,000, 51,000 less. Automated. Department is sending me notice saying that sir, e-way bill is showing, data is showing your sale should be 35,83,000, but you have sold only 35,32,000 in GSTR 3B where you paid taxes. You have paid taxes less of 51,000. Kindly pay it now along with applicable interest. Same year, 51, 26, 26. Taxpayer has to reply, tax officers need to figure out. This is a reconciliation statement. Tax officers need to understand, we need to understand that if you see on the top, that is liability as per your sale, your tax amount, CGST, SGST, IGST on sale as per e-way bill data. And at the bottom, it is tax amount as per 3B data. In between plus minus is there. Let us understand that. Sir, first add, if you can see our screen please. First, outward supplies pertaining to supply. in respect of which e-way bill is not required. Outward supplies pertaining to supply of service in which e-way bill is not required. Sir, for service, do we need to have any e-way bill? For service, do we need to have any e-way bill? How can we have e-way bill? E-way bill is for monitoring the movement of the goods from one place to the other by truck. So your service, do we have any tangible aspect of service? No, it is over the phone or computer, right? So in e-way bill, there is for services, supply of services, no e-way bill. So on top, if you were to see this sale of 38,000, which is towards supply of service, it is not there. But in GSTR 3B, we need to pay tax on our sale of service, right? So we need to add that particular sale of service from our e-way bill data to reach the total sale amount in GSTR 3B. Are we getting this point? Second point, intra-sale. This is second. Sale in respect of intra-state sale where the invoice value is less than 1 lakh. Do we need to generate any e-way bill? No. But we need to record it as sales. We need to pay taxes on that, right? In 3B, if we don't do it, will be short levy of tax. So that 1,10,000, it is reported in 3B, but it is not, no e-way bill is reported on that. So we add that to reconcile to the top amount. Then third point, invoice value of interstate is less than 50,000. Do we need to generate any e-way bill? No. So e-way bill on top, there is no figure of 23,704. But in sale, in 3B, I need to report. So I need to add this amount 23,704 to the top figure in e-way bill. Right? Now reverse, let us see. Credit notes. Credit notes in respect of sale, which is intrastate less than 1 lakh, intrastate less than 50,000. In respect of that, I am returning the goods back. E-way bill, do we need to generate e-way bill in those cases? When we are returning back the goods and the invoice value of the goods, intrastate is less than 1 lakh, interstate is less than 50,000. Do we need to generate e-way bill? Of course not, because when we did the sale, we did not have to generate. When we are getting back the goods, how will we generate e-way bill then? Because it goes below the threshold. So, but I need to what? I need to downward adjust my sales in 3B naturally, because I am issuing what? Credit notes. I am receiving back the defected goods from my customer. So 3B has minus of this credit note. E-way bill generated or not? No. So what do I need to do? I need to, this is higher, this is lower. In 3B I have already adjusted credit notes. E-way bill has not been generated. E-way bill sale is higher. I need to reduce the amount of credit notes on which e-way bill is not to be generated from the top. So less. E-way bills, second last point, e-way bills not generated by me. E-way bill generated by the buyer, consignee. E-way bill generated by the transporter. Will it come in my e-way bill data on top? Of course not. It will not come in my e-way bill data. It will show, when we download the e-way bill data, it will show any other person. It will not show in mine. So, but I have recorded sales of that. So, what do I need to do? This is for credit notes. So, credit note issued by the transporter or the buyer when he is returning the goods. So, when I am receiving the goods, when the goods are being returned which I have sold, my GSTR 3B goes down. But e-way bill is not generated by me only, it is generated by the buyer. So, this top part, e-way bill, credit, in respect to credit note is higher. So, I am going to reduce. So, this is the reconciliation, there is no difference. This we need to understand very carefully, because each file which we are going to get for PL, your financial statement, balance sheet, all of those things, there will be a difference between way bill, and we are going to issue these kind of notices. When our taxpayer client, he submits this, we need to understand this kind of reconciliation. It comes in almost every hearing, or it comes in almost every case. Now, for turnover, we have already discussed, sir, stock transfer. In case of financials, stock transfer are nullified. We have already discussed this. But in GST, it is included in the turnover. We have already discussed this point. Sir, exchange rate difference. Sir, I am selling the goods outside, export. Now, exchange rate difference, what happens is, at what rate should I record the GST sale? Do I take any RBI rate, go on any website, take the RBI rate, or any rate from the stock market, moneycontrol.com, yahoo.india.com, etc., Yahoo Finance? No. As per Customs Act, Section 14, as per Customs Act, they have every day published rate. We need to take that rate if my sale has been made on that date, and I take that dollar 84.35 rupees for $1 as per the custom section 14, and I take that and I multiply that into my dollars receivables, and I record that as my GST turnover as per GST. But sir, when I am recording in my books of accounts, when I record it in my books of accounts, there is a separate accounting standard of foreign exchange. What does that accounting standard say? Average rate. You need to take average rate for the year. What is average rate? The rate which is published, it is, every day, the top and the bottom divided by 2, and then throughout the year divided by 365. Average rate for the year. That is different from the published rate as per Customs Act. So sir, $1,000 of sale you have done into 84.35 rupees as per Customs Act, into 82.7 rupees as per average rate. My book sale is so understated. 3 rupees per dollar is understated as per my books, and my GST turnover is overstated by every dollar 3 rupees. So in that particular case, I have not short recorded in my books, or I have not over reported in my 3B, or vice versa. I need to reconcile. I need to see, sir, which average rate you have taken for your books recording of your export turnover, and what was the custom registered rate for that particular date. It's very important. Exchange rate, which I have already mentioned here. Sir, HSN, we are aware, right? What is HSN, sir? Harmonized system of recording, right? Every good has its own chapter. Then there are 2 codes, then 2 codes further, then 2 codes further, then 2 codes further also. There are 8 digits, 6 digits, 4 digits, 2 digits, right? We are aware of that. Sir, what is the rule? Now, what is the rule? From 24th of August 2021, very important notification, notification 78/2020. For every B2B invoice which is being of sale issued by a taxpayer having an annual aggregate turnover of more than 5 crores. Matlab, today 2024-25 and 2023-24, my total pan-India turnover was more than 5 crores. If this 5 crores, what does it include? Taxable turnover, exempt turnover, export turnover, all of those things. And if that exceeds 5 crores, then above 5 crores, then for each invoice I am issuing, each B2B invoice, B2C invoice also, the seller, the person who has turnover of more than 5 crores in the previous year, has to mandatorily mention 6 digits of HSN. This is the law. For those taxpayers who are little smaller, for those taxpayers whose annual aggregate turnover is less than 5 crores of previous year, means taxable supply, export supply, exempt supply also. If I am selling electricity, will it be added? Yes. If I am selling duty credit scrips, will it be added? Yes. If I have savings interest on my bank deposits, interest on fixed deposits, will it be added? Yes. All of that will be added. It is not in purview of GST only, exempted by exemption notification. All of that will be added to calculate annual aggregate turnover. And if that is lower than 5 crores of previous year, for each B2B tax invoice which you are issuing on sale, you have to have a mandatory minimum 4 digits. For B2C invoice, for taxpayers lower than 5 crores, no requirement to mention any GST, HSN. This is the law. Sir, last year, 15th of December 2023, sir, e-way bills, it's become mandatory. This I am talking about what? What am I talking about? Invoice, tax invoice under section 31. But here, e-invoices, it has become mandatory for what? E-invoices and e-way bills. If now you do not mention 6 digits in e-invoice will not be generated. For e-way bills also you need to mention these. So we as tax officers, we need to understand that whether this has been complied when we are doing GST audit, when we are doing reconciliation of way bills with our tally data or with our ledgers. We need to see that, okay, kindly give me some sample tax invoices and I want to see whether you have followed this HSN method or not. Otherwise, if this is not followed, what will happen? As tax officer, I have the authority to impose a general penalty under section 125 of 25,000 each under CGST, 25,000 each under SGST. We have the right as tax officers to do so. Second point, discount allowed. Sir, very, very important. Let us understand this is amendment of last month. Sir, discount allowed. Are we aware of what is discount allowed, sir? If in a balance sheet, PL, if in other income I am seeing discount received. Many times when we study PL, in other income we see discount received. It is an income. I have received discount from my supplier, discount received. I will record it in the credit side of the PL, right? It is an income. Sir, but discount received, if I have received discount. Now, what is the GST perspective of it, aspect of it? There can be how many types of discounts? 2 types of discounts. First type of discount, when in the invoice itself, 100 rupees, for what? 5 shawls or 5 pants I have bought, minus trade discount, minus cash discount, minus volume discount or whatever nature, discount 5 rupees in the invoice, 95 rupees. I will collect GST on 95 rupees. That is the discount at the time of sale mentioned in the tax invoice. No confusion regarding that. Sir, second biggest confusion, post-sale discount. What is post-sale discount? Ajay sir, I am a distributor of Hitachi, whatever AC. Okay. I have from the Hitachi company is given me a target of 100 ACs to sell throughout the year. I reach 110. He will give me volume discount. He will give me some sort of a discount, right? Right? Volume discount or something. Post-sale discount. So there are different types of post-sale discounts also, which I give my buyer. Now what happens here? First, this one. This is the amendment which has happened by Circular 212/6/2024. Happened last month. This was also mentioned in the 53rd GST Council meeting, as well as moving ahead. We are expecting to get a circular has come. So this has become law for you. Sir, let us try to understand what does the circular mean for a tax officer. Circular, departmental circular is binding on the tax officers, but it is optional on the tax payers. We need to understand this concept very, very properly. For ourselves, this is mandatory. We cannot escape this. We cannot escape this. So we need to understand what this is. For me, it is optional. Right? So now as per this circular, what has happened? This means that if there is any discount received in any PL other income which I will see, I have received discount from my supplier. As a tax officer, when I am seeing the balance sheet, I will see that discount received. Discount received, what does this mean? This means that he has received it from his supplier. Supplier has sold something, so supplier would have issued a credit note to reduce his sale because it's a discount. He is giving a discount, so his sale is getting reduced. You are getting a discount, so there will be a debit note as per books, not GST. GST में इसका debit note का कोई value नहीं है. What I am trying to say, first we need to see discount received. Has the manufacturer issued any credit note? Yes, okay. I will ask for the credit note from the taxpayer. I have got the credit note. Second thing, if I have received discount, I should be issuing a book debit note. Means I need to reverse input tax credit of this 5 rupees of discount. 100 rupees worth of textile has been sold to a particular buyer, which means me, from the supplier. After 2 months, he issues a credit note, post-sale discount, 5 rupees. So, his sale is 95 rupees. My purchase is 95 rupees. But the first day when my purchase came, invoice came, 100 rupees was there. So, 5% of 100 rupees, 5 rupees I claimed 2 months ago. But now my net purchase is 95, 5 rupees to give me discount. So 100 rupees purchase has become 95 now. So you have claimed 5 rupees then. So please reverse input tax credit equivalent to the discount 5 rupees. Are we getting this particular point? Whenever we see discount received, post-sale discount in the PL, we need to see whether we have reversed the input tax credit or not. If we have reversed the input tax credit, now let us understand this. This is extremely important. We have understood till this point. 5 rupees, 5% is how much? 25 paise, for example. So 25 paise have I, as the buyer, reversed in his tax ledger, right? Now, try to understand, 95 rupees my purchase, I have to reverse, mandate. But for the supplier, his sale has become 95 now. But initially, when he issued the tax invoice of sale 100 rupees, he collected 5 rupees from you and he paid the government 5 rupees. But now the sale is of 95 rupees. So 5 rupees, 25 paisa, 25 paise, which is paid extra to the government. He needs to downward adjust it now, right? Because sale is not of 100, it's of 95. 5 rupees I paid to the government. On 5 rupees I have given discount. So 5% of 5 rupees, it will be what? Downward adjusted in the current month. 2 months later when I issue my credit note. So this is the benefit of downward adjustment of tax liability in the month I issue the credit note for the supplier. ये बात concept समझ में आया? Benefit क्या है? खराब होता है what? There is a disadvantage for the buyer. He has to reverse his input. But there is an advantage by issuing credit note from the point of view of supplier, because he gets the benefit of downward adjusting his tax liability in the month when he is issuing the credit note. Are we understanding this concept? Is everyone on the same page? Now, when does the supplier get the benefit of downward adjustment of his tax liability? Example लेते हैं 1000 rupees sale, okay, 100 rupees credit note, 1000 rupees sale. So 5% of 1000 is how much? 50 rupees. 50 rupees tax he is paid. 2 months later he issues a credit note of 100 rupees. 5% of 100 rupees is 5 rupees. So net sale is how much? 900 rupees. But he has paid tax of how much? He has paid tax on 1000 rupees, that is 50 rupees. So 5 rupees, which is now the tax equivalent to the credit note. So net should be 45 rupees only not to the government. So 5 rupees he should take back from the government, which he has paid 50 rupees earlier. It should be 45. So 5 rupees he should take back from the government. How will he take back? He will not apply for refund for this. Na? He will downward adjust in his current month sale. 2 months later his sale is, for example, 1 lakh rupees. And he has to pay 5% tax on that, for example. So 1 lakh rupee, 5,000 rupees. So he will adjust this 5 rupees against what? 5,000 rupees tax. He will now pay 4,995. तो इस benefit है ना उसका 5 रुपया का कम tax payment करेगा 2 महीना बाद में. But when will he get this benefit? Sir, new law has come. He will get the benefit of downward adjustment of tax liability 2 months later by issuing a credit note only when he gets a certificate from the recipient that the recipient has reversed this 5 rupees of input tax credit in his books and in his GSTR 3B. Sir, onerous burden on the taxpayer. Onerous burden. हम काम धंधा देखें कि उससे बार बार I will contact my buyer and I will say, oh अच्छा sir, for post sale discount give me this certificate, for post sale discount give me this certificate. I have more than 500 buyers. I am a big dealer. From each buyer I am giving some post sale discount to my retailer. 500 buyers I am going to get 500 different certificates that you have actually reversed input tax credit in respect of this credit note which I have issued. And once I receive that certificate, then only I will be able to downward adjust my tax liability in my 3B. Are you understanding this concept? Now, this 5 rupees, if it's more than 5 lakh, try to understand. If for credit note with a tax on discount involvement of 5 lakh, what does this mean? This means that if I have issued a credit note of, for example, 10 lakh, for example, 1 crore rupees, and I have tax rate of 12%. So 12 lakh rupees is the amount which should be reversed in the 3B of the buyer, and I will get the benefit of downward adjustment of my output tax in the next month of 12 lakh rupees. Is it more than 5 lakh? Yes. It is more than 5 lakh per a buyer, per a retailer. For each retailer more than 5 lakh for 1 year, you need to receive a certificate from a CA, chartered accountant or CMA. सिर्फ सर्टिफिकेट बायर से मिलने का मतलब कि it will not be sufficing because the big amount. So now what will happen in this certificate? What will happen in this certificate? In this certificate, the chartered accountant of the retailer buyer, he will mention first thing, oh acha, the input tax credit reversal is 12 lakh rupees, more than 5 lakh rupees, okay, for post sale discount. So whether it has been reversed? Yes, it has been reversed. How has it been reversed? It has been reversed in DRC 03 or in 3B by the retailer, by the buyer. Which 3B? which DRC03 number I want, ARN number I want, and linking one credit note has been issued of 12 lakh rupees by the supplier, right? And this 12 lakh rupees has been reversed by the buyer, the retailer. Now, this particular reversal is linked with which invoice and credit note? That also needs to be mentioned. I issue 1000 invoices, 1, 2, 3, 4 up to 1000. In respect to 44th number of invoice, I give a discount of 12 lakh rupees. So the chartered accountant has to mention in his certificate that invoice number 44 linked with credit note number 001122 dated this has been reversed in the books of accounts of the retailer, which is the buyer. When, in which 3B, which amount, all of those things need to be mentioned, and that certificate needs to be provided by the chartered accountant of the buyer to the supplier. Then supplier receives it, he downwards adjusts in his GST 3B. Are we understanding? It's a very onerous burden on who? The supplier, to get the benefit of downward adjustment of tax liability in respect of credit notes issued for post-sale discount. Now this new rule has come, the circular has also come, it has become law. For less than 5 lakh rupees, no chartered accountant certificate required. The recipient, buyer, retailer, he himself can issue a certificate in his letter. Whenever there is a certificate from a CA or CMA, sir, there is something called UDIN, Unique Document Identification Number, like the way we have DIN, Document Identification Number, right? We must all be aware that every communication from the central department to any taxpayer in any form needs to have a DIN. In case if DIN is not there, within 15 days, it needs to be generated, and in the notice itself it needs to be mentioned why, what is the reason why DIN could not be generated, right? This is law, circular 123 or something it was, you know. So the same way we have, chartered accountants have UDIN, Unique Document Identification Number. Any certificate from a chartered accountant or cost management accountant without a UDIN holds no value. This is very important for departmental officers to keep an eye on every certificate received from chartered accountants. UDIN is there. Where is UDIN mentioned? Usually our signature is there at the bottom. Below that date, UDIN is there. This UDIN can be checked also. I'll just type any gibberish 16 alphanumeric letter, I will pass it off as UDIN. No, there's an open portal, udin.ici.in. Just go there, okay, and type this UDIN, click. It will show which CA, at which date, for which company it is issued. You can certify this is a legitimate, legible, valid, existing document or not. It's very important for us to know this. So, till now, any questions? Please feel free to ask me questions. कोई भी लैंग्वेज में आप लोग पूछ सकते हैं, कोई इशू नहीं है. Let us get the most value out of today's session. We will touch upon a lot of other concepts also. But कोई भी क्वेश्चन है तो आप बीच में प्लीज रोक करके क्वेश्चन जरूर पूछें. Okay, so we are going to move ahead. See, sales promotion schemes. Now, whenever we see a PL account, profit and loss or income statement, so there we would be seeing a ledger called sales promotion expenses. Or we may be seeing, okay, you know, something like miscellaneous expenditure, sales promotion, marketing. See, these names, these ledgers, you know, we should halt and we should drill deeper into these ledgers, because many a times companies or taxpayers, they put into these ledgers certain expenditures which may be personal in nature. We may be aware of concept called block credit under section 17 subsection 5. So in that it is mentioned that any input tax credit which is in pertaining to any inward supply which we have utilized for personal consumption. For example, if we have bought an AC but we have not put it in our office, we put it at our place, at our house, so input is not available for that. In case if we buy a mobile phone for our personal use and we mention there in our PL balance sheet there, okay, so in that particular case also it is for personal use. So this is very important for us to understand and spot these kind of ledgers. Let us understand the GST rules behind this. Free sample of gifts. Now see, there may be certain samples, free samples which we give out. For example, for doctors, physicians, some medicine or something we give, gold coins we give to our dealer, we give our dealer some incentive scheme, or we give as free samples. In that free samples of our products, it is mentioned not for sale, for physician use only. So what does free sample mean? Free sample means that we are not getting any consideration in return. We are not selling it for any rupees, right? So in that particular case, are we collecting any consideration? Are we collecting any tax? No, we are not. So it is not a taxable supply in the sense that we are not collecting any tax against it. So sir, are we going to be allowed input tax credit? Logically no, right? If we are selling free samples, giving free samples for trial basis or for only physician use or not for sale, so in respect of that, as per section 17 subsection 5, which is block credit, there is no input tax credit. You can claim in respect of that. If you have claimed it, you have to reverse it permanently. Where do we reverse it? Have we seen GSTR 3B format? Are we aware that table 3 is table 3.1? All of that is mentioned for outward supply sales. Table 3.1A is for domestic, 3.1B is for export, like that, right? And table 4 is for input tax credit, right? So table 4A1, 4A2, 4A3, 4A5, all other ITC. 4B1, 4B2, are we aware what is that? That is for reversal of input tax credit. So 4B1 is for permanent reversal of input tax credit. 4B2 is for temporary reversal of input tax credit. So these kind of input tax credit which we have claimed earlier, now we are giving it as free supplies. This is blocked in nature. We have claimed it earlier, now we have to reverse. Where are we going to reverse? In table 4B1, which is permanent reversal. We are not going to get it back, right? Now buy one get one. What does this mean? We have these promotion schemes, we have these marketing, these strategies, buy one get one free. So buy one get one free, it is a method wherein the cost of the second product or a part of it is included in the first product itself. So the sale consideration only contains the value of both the items which are being sold. So in this particular case, it is a normal sale. You don't need to reverse any input tax credit. Buy one get one means the cost of both the products are included in the sale consideration. So no extra reversal is required, nothing. It is just a normal transaction, right? Now I have even mentioned here section 17 subsection 5, right? For reversal of cases of free samples or gifts. Now see, there are two companies, holding company is there, subsidiary company is there. We are seeing the balance sheet and PL of a holding company. In holding company, what is holding company giving? Holding company is giving some loan, advance to the subsidiary company. When we see the balance sheet, we are going to see in the asset column that we are giving some advance or loan to the subsidiary company. Now the subsidiary company will give us some interest against that, right? 8%, 10%, 12% as per the contract. Now sir, this interest which the holding company is earning on the advance or loan given to the subsidiary company, whether that interest GST is applicable or not. GST is not applicable because it is specifically exempt, right? Entry number 27A of notification 12. This is a master notification for exemption in terms of supply of service. This notification number 12 2017, right? So entry number 27A. So when we are seeing any company balance sheet or in PL other income, in other income interest income we see. So we are going to drill deeper. We are going to see interest against what? Interest against delayed payment by the customer. So in that particular case we need to issue a debit note and GST will be charged on that, we are aware, right? Because it is a part of the transaction. But interest in respect of any loan, any advance given to anyone, if we earn that interest, no GST aspect is there, it is specifically exempt. Now sir, when we talk about exempt supply, what is the first thing, as I mentioned, triggers in our mind? Reversal of proportionate input tax credit, because this is an exempt supply as we saw initially, rule 42, rule 43, right? But this is also an exception, as was the sale of duty credit scrips, that no reversal of common pool input tax credit is required when there is an exempt supply. This is not a supply also, this is an exempt sale of what? Interest, earning interest on loan and advance. So no reversal of input tax credit is required in this case also. But sir, third thing, will this be a part of the annual aggregate turnover of the company? What did I say? Annual aggregate turnover to determine so many things under GST, right? Annual aggregate turnover for QRMP scheme, annual aggregate turnover for levy of penalty, all of those things. So annual aggregate turnover, it includes taxable supply, it includes export supply, it includes even exempt supply. So this particular earning of interest against any amount which is given as a loan or an advance, that will be a part of annual aggregate turnover, right? Now let us understand this. Sir, we are going to see in other income, as we saw, sale top line is there, right? Sale turnover is there. Below that there is other income. In other income, interest comes, discount received comes, other types of income comes. One income is profit on sale of plant and machinery. Profit on sale of or loss on sale of what? Capital goods. Capital goods means what? Goods which we are buying to conduct our business. For example, plant and machinery. For example, this furniture. For example, the lights, fans here. We are going to capitalize that. And when we say we capitalize capital goods, what do we do under Income Tax Act? We get the benefit of depreciation on that capital goods every year. On furniture, as per Income Tax Act, depreciation rate is 10%. On plant and machinery, on this particular computer, for example, on computer it is 40%. On plant and machinery, AC, it is 15% every year, right? So what happens here? We need to check first. First rule is on any depreciation. For example, I have bought this furniture and I have capitalized this. This furniture value is, taxable value is 50,000. I have paid 18% on this, 9,000 rupees. This 9,000 rupees which I have paid, that becomes my input tax credit. I can claim this input tax credit, fine, and I am going to capitalize this furniture in my books of accounts value of 50,000 or 59,000. Can anyone reply? The invoice value is 59,000, 50,000 is the value of the furniture, means the taxable value. 9,000 I paid on 18% on purchase of this furniture. So total invoice value is 59,000. 50,000 is the taxable value, right? Now, when I capitalize the furniture in my books of accounts, it will be 50,000 or 59,000 on which I will get the benefit of depreciation. Depreciation every year will be calculated on 50,000 taxable value or 59,000 including of tax. 50,000, absolutely correct. It should not be 59,000. Why not 59,000? 9,000 benefit you are getting as input tax credit under GST. On the 9,000 again you will get benefit of depreciation in Income Tax Act. No. So as per GST you need to check when you are seeing the fixed asset sheet that the invoice taxable value is only mentioned, fine. The tax amount should be claimed as input tax credit. Now what happens when I sell this furniture after say 2 years? I want to sell this. So when I sell it, what happens? When I am selling it, I am getting some sale consideration. I bought it for 50,000. 2 years later, the value would be what, 22,000 because it is depreciated, right? In that case, what is the treatment? See, let us take this example, we will understand. Mr. X sold his machinery, plant and machinery for 1,44,550. 18% GST on 1,44,550 is 22,050, right? This is on selling the machinery. This is the sale consideration. 1,44,550. This is the output tax which I need to pay, right, on selling. But I have purchased it. When did I sell it? On 10th of May 2019. When did I purchase the machinery? On 1st July 2017. For what amount? 2,36,000. And 2,36,000 includes 36,000 of GST. So 2 lakh rupees is the taxable value of the plant and machinery when? On 1st of July 2017. This example is clear. Now, when we are selling this, when on 10th of May 2019, what is happening? There is some section 18 subsection 6. What does it say? It says that we need to pay higher of the two. What is the higher of the two? First is, I am selling it for 1,44,550. Then, so 18% on the sale consideration taxable value is 22,050. This is so simple. Transaction value, tax on that when I am selling, right? So first is this. Second is an amount of input tax credit as reduced by such percentage point as prescribed under the rules. What does this mean? This means that, see, there are two rules under GST, Rule 40 sub Rule 2, Rule 44 sub Rule 6. What does this mean? Rule 40 sub rule 2, what does it say? It says that we are going to calculate what? How many quarters have passed? Can anyone tell me? Between sale and purchase, how many quarters have passed? I have bought it in July 17. I am selling it in May 2019. Quarter means what? January, February, March is one quarter. April, May, June is another quarter. So how many quarters have passed? July, August, September, October, November, December. 2 quarters of 2017. 2018, 4 quarters. 4 plus 2, 6. 2019, January, February, March. And April, May. 2 quarters of even 2019. So 2 plus 4 plus 2, how many? 8 quarters have passed. So 8 quarters have passed. Now rule 40 sub rule 2, it says that for every quarter 5%, I will assume that 5% of input tax credit on every quarter is being actually whatever dedicated to that. So what is it saying? For 8 quarters, I have utilized 5% of this input for each quarter. So I have utilized 40% in these 8 quarters. 40% of what? 36,000. Right? See, under GST law, the life of an asset is 5 years. 5 years is how many quarters? 5 years is how many quarters? 20 quarters. 20 quarters, na? So GST, as per GST law, the plant and machinery is 20 quarters. But only 8 quarters have been used, 12 quarters not used. So they are saying that proportionate 12 quarters means 60%. 60% of 36,000, the time the input tax credit when I purchased it, 60% is unused because I did not sell it after 5 years. I sold it after in 8 quarters only. I should have used it for 20 quarters. So for 12 quarters which I have not used, equivalent input tax credit calculate and reverse. Is this concept clear? So what is the value of 12 quarters proportionate of input tax credit? For 8 quarters, 5% each. For quarter is 40% of 36,000 I have used. 60% of 36,000 is 21,600 unused because I am selling it before 5 years. So now whichever is higher, which is higher? On normal sale, 1,44,550 into 18%, 22,050. This amount or the proportionate reversal of input? Which amount? Proportional reversal of input is proportional 21,600. So 22,050 or 21,600, whichever is higher. So whichever is higher, 22,050 is higher. So taxable value will also be 1,44,550. Tax amount will be 22,050. Fine. Now this is one rule. The other rule is rule 44 sub rule 6. This says that concept is same. Do month wise. Don't do quarter wise. I don't understand quarter. I want to understand month. 5 years is how many months? 60 months. So 60 months is the lifespan of any capital good under GST. How many months have you used, sir? Part of a month is calculated as month. How many months have you used? Let's calculate. 1st July 2017. July, August, September, October, November, December. 6 months of 17. 18, 12 months. So total 18 months. And 2019, 5 months. So how many months? 23 months. 23 months worth of input I have assumed, absorbed because I have used it. 60 minus 23 is how much? 37. 37 तो फोकट का हम claim करके रखिए. I have sold it within 5 years only. So please reverse it. Proportionate input of 37 months unused period. So calculation, how does the calculation come? 36,000 is 100% of input tax credit into unused period divided by 60. 37 months unused divided by 60, which is the lifespan. So 22,200 rupees out of 36,000 I should reverse now because I have not used the goods, the capital good for 5 years. So whichever is higher, what was the transaction value? 22,050 or proportionate reversal is 22,200. This is coming to 22,200. Whichever is higher. Which is higher? 22,200 in this case. So sir, my taxable value will be 22,200 divided by what? Divided by what? 18%. Taxable value cannot be 1,44,550. Tax amount is 22,200. So we need to back calculate and find out the taxable value. How can we take taxable value of transaction value and then we take tax amount which is higher? If we divide that, exact 18% won't come. So we are going to back calculate. If you are paying the higher tax First tax amount comes divided by 18% comes to gross up taxable value. That taxable value becomes your sale value. And this is the amount which you have to pay. So this goes in GSTR 1 sale. This goes in GSTR 3B sale. Are we understanding? But as per accountancy, all of this do we need to do? No. As per accountancy, what is there? 1,44,500 is the sale value. What is the purchase value? Purchase value is 2 lakh rupees. And depreciation per year, how much do you get? On plant and machinery, 15%. Right? So 2 lakh minus 15%, one more year in 2000. This is 2017-18, 18-19, one more year of depreciation. So 15% again. So 2 lakh minus 30%, 70% of 2 lakh is how much? 1,40,000. What is 70% of 2 lakh? 1,40,000, right? So 1,40,000 is the written down value, WDV, as per books, right? And we are selling it for what? 1,44,550. So there is a profit of 4,550 as per accountancy in other income. But when we are going to drill in, we are going to see this valuation rule. We need to apply. This is different. Are you understanding this? Very important, this concept. Whenever any capital good or plant and machinery is being sold, these two rules will come into play. Next, car. When I sell a car, I may sell the car second hand, used car. I buy it, I sell it. So there will be some loss or profit. In other income, it will show loss on sale of motor vehicle, profit on sale of motor vehicle in other income, right? In the credit side of the PL. Now, for car, there is concessional rate for pre-owned or second-hand cars if we are selling it. After 25th of January 2018, 12%. Now, these are the parameters. Petrol vehicle, Santro is there. Santro CC is how much? 1190. So it is less than 1200 cc engine, and it is less than 4000 mm. It's a small car, hatchback. So there, what will happen? We will there, for Santro, if we sell, it will be 12%. But now we are selling Creta, Fortuner, big SUV, 18%. If we sell big car, sedan, like for example, Corolla Altis, Mercedes Benz, that is more than 4000 mm, engine capacity of 3600 cc, it will be 18%. These are all concessional rates. These were before, these are after. We need to see these, right? Now, when we are selling a motor vehicle, let us see this example. Motor vehicle. We have a different valuation rule as per motor vehicle. What is the valuation rule, sir? Sale value. I am selling my Santro after using it for 2 years, 3 years, 4 years, whatever. So, first let us understand, when we bought the Santro, did we claim input tax credit? Can we claim input tax credit on purchase of motor vehicle? We cannot, because it is specifically blocked under section 17 subsection 5. So we have not claimed it. We bought it for 10 lakh rupees. Okay. Now we are selling the second hand car for 6 lakh rupees. Now I have used it for 2 years. Now what happens is, my WDV, written down value, as per Income Tax Act, not Companies Act, Income Tax Act, very important. On the date of sale, the written down value as per Income Tax Act means 15% for 1 year, next year 15% on the written down value. I have to calculate the value, written down value as per Income Tax Act, and that amount comes to 4 lakh rupees. Today when I am selling it for 6 lakhs. Is there a positive margin? Yes, of 2 lakh rupees. Positive margin means what? Profit. So the rate, which is concessional rate of Santro, 12%, will be applicable on the margin of supply, positive margin 2 lakh rupees. Are we understanding this? Are we understanding this concept? Let us see this another example. My Santro, I am not getting that much value. I am selling it at 4 lakh rupees. I am getting it from some online website, OLX or somewhere, Car Dekho. I am getting it for 4 lakhs. But my book value, depreciated book value as per Income Tax Act is 6 lakhs. I am selling it at a loss. I want to sell it. This car does not give me good mileage. I don't want to keep it. Right? I am selling it at negative margin, 2 lakhs. Means sale consideration on the date of sale minus the written down value in the books as per Income Tax Act 1961, not Companies Act. That is 6 lakhs. 2 lakh rupees of loss means negative margin. So they say no GST. They give the benefit. No GST is to be put only here. Sir, GST is always levied on the transaction value. Section 15, Section 7, we know that. This is an exceptional case. Profit loss is showing. This is an exceptional valuation rule for sale of second-hand cars. Are we understanding this concept? So in the second case, no GST will be levied. So now whenever we see in other income, in PL account on credit side of any business, profit from sale of motor vehicle, 5,000 rupees. We will not take that only because that is as per accounting rule. Accounting rule, sir, what will happen? If it is a company, depreciation will be provided as per Companies Act. Right? Companies Act does not say 15%. Companies Act gives a lifespan of 10 years, 5 years, and then they proportionally reduce. So the written down value as per Companies Act can be, here it is 4 lakh rupees as per Income Tax Act, it can be 4.5 lakh rupees, the value of written down value. So in that particular case in the books, the profit may be 1.5 lakh rupees only. But here as per our valuation rule, the margin is coming of 2 lakh and GST is to be charged on that. Why am I saying all this? When there is another income, loss of profit from sale of motor vehicle, we are immediately going to open this particular notification and this particular rule, notification 1 2017, read with 08 2018 central tax rate. We are going to take the concessional rates and we are going to apply this particular rule. This may be different from the figure of the balance sheet if it is a company, right? Because they will have written down value as per Companies Act. This is as per Income Tax Act. Are we understanding this particular point? Right. Now, let us understand this. If we have in our PL account, in indirect expenses, staff welfare expense means whatever done, I have 50 staffs, employees, and I want to give them some welfare scheme. In the sense, I am going to give them Medicare, insurance, I am going to give them canteen service, I am going to give them club membership, I am going to give them some food and beverage. All of these things, can I get input tax credit on the same? Can I get input tax credit on the same? We cannot get input tax credit on the same. Why? Because this is blocked under section 17 subsection 5. What is blocked under section 17 subsection 5? Any club membership, any medical insurance premium, life insurance premium, food and beverages, any staff welfare scheme, club, beauty parlor, anything which I have done, all of these things are blocked. If I am renting a car, rental car service, and I am giving it for my staff to go back home every day, is this allowed? This input tax credit, is it allowed under GST? I have female employees in my team. My work gets over after 8 o'clock. And there is a specific law in West Bengal that after 8 o'clock, if you are a commercial establishment, you need to arrange a mandatory transportation by car. For that you need to pay rent of the car. For that you need to pay GST on that to the car provider. And then give that to the female employees, they will go home. In that particular case, can I claim input tax credit in respect of the tax amount which I paid for rental of the car? When there is a specific law mandate in the state or by the center? Yes or no? Yes. Yes, we can. Here, see this. This is an advance ruling also of Tamil Nadu. Tamil Nadu government has a mandatory law as per Tamil Nadu shops and establishment that it is obligatory, means mandatory for the employer to offer transportation service to women employees after 8 p.m. up to 6 p.m. So in that particular case, when the officers such as yourselves, you were rejecting this particular input under section 17(5) block credit, this is mandatory as per law. So I can claim the input. This is an exception. Important for us to know. Sir, I have 500 laborers, big factory. As per my Factories Establishment Act, Factories Act, it is a national act, Labourers Act, Factories Act. It is mandatory for me to keep water dispenser, a canteen, food and beverages to all these 500 laborers every single day. Am I allowed to get input tax credit on food and beverage also, which is specifically blocked under section 17 subsection 5? But it is mandated under Factories Act. Yes, because Factories Act is a statute. What is mentioned here? This is the law. I am not saying this is the law. Here, this one. Provided, there is a proviso to section 17 subsection 5 block credit, provided that the ITC in respect of goods or services or both shall be available where it is obligatory, mandatory for an employer to provide the same to its employees under any law for the time being in force. Factories Act, PF Act, Labours Act, Tamil Nadu State Act, Professional whatever establishment acts, West Bengal, if anything is mandatory, and food, beverage, transportation, anything specifically blocked under 17.5, we can still get the benefit. Important for us officers to know this, because whenever we will see commute charges, conveyance charges, employee staff welfare charges, we are going to see all of this, all blocked. But we need to see whether it has establishment under Factories Act, whether it has establishment under any particular law mandate, then it is allowable. Are we understanding this particular point? Let us see this point. Prepaid expenses. Do we know what prepaid expenses are? Prepaid expenses means I have broadband of Airtel. Here, this is my office. I paid for 1 year. 6 months of 2025-26 also, next year. So for 25-26, 6 months is prepaid because I paid in 24-25. Right? So in 24-25, can I claim the input tax credit which I paid for 25-26 also? It is prepaid for the next year for 6 months. Can I claim? Yes or no? I cannot claim. Reason? Section 16 subsection 2 clause B. What is section 16 of GST Act? It provides conditions to claim input tax credit. First condition to claim input tax credit, we should have a valid tax invoice. Second condition, we should actual receipt of goods or services. So here, have we received the services yet for 2025-26, which is next year prepaid? No. When I am going to receive the service next year, then I am going to claim the input. Same way, goods in transit. When I am seeing inventory, goods in transit, I have per day I have 200 kilometers provided, right, for e-way bill distance. My goods are coming from Gujarat and it is 400 kilometers away. It has not reached my godown in Dhulagarh in West Bengal. But this particular invoice I have received from my supplier 30th of June 2024. I have received the invoice. He is uploaded in his GST-1. It is appearing in my 2B. But goods I have not received as on 30th of June 2024. Can I claim input tax credit in respect of the goods in transit in June month itself? I have invoice. I have the input tax credit appearing in 2B. I have paid the taxes to my supplier. I am going to file my 3B of June. All the conditions satisfied. Just one condition not satisfied. I have not received the goods in the month of June. I cannot claim in the month of June. So temporary reversal of input tax credit when I am filing GST 3B of June month in table 4B2. 4B1 was permanent reversal. 4B2 is temporary reversal. And next month when the goods come in on 1st of July, 2nd of July, it is already appearing in my 2B of the last month. I have invoice, I have received goods, I have paid to the supplier has paid it to the government, etc. All of those things. In July, I will claim the input tax rate which I have temporarily reversed in 4B2. In July 3B, where will I claim it? In table 4A5, by hand automatically I will put, and in 4D1 I will report it. That temporarily reversed input tax credit of previous month being claimed now. Right? Now, director remuneration. Sir, I see PL account. I see an LLP, limited liability partnership or partnership firm. After net profit, there is appropriation of profit. Means director remuneration, partner remuneration. So, for a company, let us see, there is an expense, director remuneration. Director, we know who all are directors who run the company. Right? There are two types of director. Executive director, second is non-executive or independent director. Executive director means whole-time director, every day working. Managing director, I am involved in daily affair. What is non-executive director? Independent director, they are outside people, chartered accountant, lawyers, people who can give outside perspective to the company and direction. They are not involved in the day-to-day working. They are just called for board meetings. Right? Are we understanding this concept? Now for regular executive directors, if the company is paying director remuneration, every month it pays, right? Every month or each board meeting, they get sitting fees also. When you sit in the board meeting, you are putting in your time. So there is some concept in companies that the company pays you as remuneration as called sitting fees. So sitting fees is once in 3 months when board meeting happens. Every month salary is there or director remuneration. Third type, I am a director of my company. I am a chartered accountant. I am a lawyer. I am an MBA. I am a CFA. So in a capacity of being a chartered accountant, I am giving personalized, specialized financial services to the company. Professional services. Or sir, this tax planning, this financial planning, this capital budgeting, this we can do. So company will give me extra 40,000 rupees as a consultant or as in a professional capacity. This is the third type of remuneration which the director gets. Now what is the GST? How do we spot all of this? This is transaction with related parties. If we have seen a balance sheet or PL, notes to accounts, there is always this mandatory notes to accounts. Mandatory under Companies Act. That transaction with related parties. So for transaction with related parties, we are going to see what? Sitting fees. This is for attending board meetings. Director remuneration. Now sir, we know that if we are giving the director salary every month as employer-employee, employer is the company, employee is the director. In the capacity of an employer-employee, do we need to charge GST on that? It is a non-GST supply under Schedule 3. We are aware of that, right? Schedule 3. These remuneration, if the director is receiving in the capacity of an employee, so in that capacity it is non-GST supply under Schedule 3. Okay. So how will we figure out as a tax officer that this is a salary and this is not a particular professional fee or anything? Sir, TDS, tax deduction at source under Income Tax Act, Section 192. 192, right? Where they deduct monthly TDS amount if your salary is taxable. If your salary is more than 7 lakh rupees in the new scheme, 10 lakh rupees. So every month they are going to deduct 10,000 rupees, right? Of your tax, TDS. So if the company is deducting TDS on monthly salary of the director under Section 192 of Income Tax Act, it is a salary. Employer-employee, no GST. First concept. Second concept, sir, chartered accountant director. I see everyday work. I am giving CA services, specialized services. There, if any payment is being made to me, the TDS will be deducted by the company under Section 194J. It is TDS in case of professional services. Section 194J under Income Tax Act, you have to deduct 10%. If monthly I get 40,000 rupees being a CA and a director, 40,000 I am just getting as a CA, I am giving specialized services. 10% of 40,000, 4,000 will be deducted every month. I will get in hand 36,000, 4,000 the company will pay to the government every month as TDS under 194J. So, when as a tax officer you are going to see, oh, acha, 40,000 is receiving director remuneration, Mr. say Bakshi, Mr. Agarwal. Acha, he is receiving as an employee. No GST. He is receiving as a professional, 194J, TDS is deducted. He has to what? The company has to pay tax under reverse charge mechanism RCM at the rate of 18% on what? This 40,000 rupees, which the company is paying as in a professional capacity to the director. Are we understanding this concept? When employee-employee relation, no GST. When professional relation in the form of director, then 18% RCM. The company will pay 18% on 40,000 rupees out of its pocket to the government every month, and it will claim input tax credit of the same amount in the same month. Sitting fees. Any GST on that? Yes. Sitting fees. We have to pay, the company has to pay RCM under of 18% on sitting fees for both independent, non-executive, for executive directors. So sir, whenever we are seeing salary, remuneration, director remuneration, staff salary, expenses, etc. in PL account debit side, we will go into the ledger in Tally or in any other software. Further inside that, and then we will see what? Salary expense or as sitting fees, director sitting fees, or as a professional capacity paying, right? So this is very important for us to understand. Commission also. Commission, in that particular case, is it salary? No. Section 194H will be deducted of 5%, right? Under Income Tax Act. The company may have to pay RCM. Sir, one more thing. My company is small. The director is giving this office space to the company on rent. Every month, 10,000 rupees rent. Say 50,000 rupees rent every month. But the director is giving this place on rent to the company to use in individual capacity as a person, not as a director. In that case of 50,000 rupees, 18% RCM needs to be paid by the company or not? Yes or no? No, he does not have to. There is a clarification. If the director is giving any service in his personal capacity as corporate guarantee, so guarantee charges, if it is collecting from the company as an individual, as a person he is doing that, not as a director. If I am a CA, I am giving it as a directorial service. But as an individual capacity in my own name, in my ITR file, I own this office and I am giving it for rent to the particular company. In that particular case, what will happen? No RCM is required to be paid by the company because the director is giving the place for rent in his individual capacity. Are we understanding these concepts? Here I have mentioned all of this. See, Schedule 3 salary is not whatever, insurance, NACIN, all of these are blocked. But if it is mandated under any law, it is required. Here also I mentioned women employee, etc. All of this we've discussed. So recoveries. Sir, I run a canteen in my factory. 50 rupees per plate for outsiders. But if you are my employee, I will give it to you for 20 rupees. 30 rupees subsidized rate. Obviously, you are my employee, it's my canteen. So, sir, I am recovering 20 rupees. 30 rupees subsidized, 20 rupees I am recovering. Whether the company has to pay RCM on this recovery from employee, 20 rupees, yes or no? I don't have to if it is mandated under Factories Act. If it is mandated under any state law, local law or central law. But if it is not mandated and if I am recovering something from the employee as canteen expense or anything like that, GST may be applicable on that. Sir, very important, notice pay. I am working in a company, I have to give a minimum period of 2 months leave, notice period, before I leave the company. It is as per my contract. I want to leave the company, but 2 months before that I have to intimate. I don't intimate. I get a very good offer, good signing bonus, but they say join immediately. So I violate that clause and I join immediately. So 2 months equivalent of salary I may have to pay to the company as notice pay penalty. We are aware of this, right? On this recovery from the employee, is GST applicable? This is as per the circular 178/10/2022. This is mandatory on the GST officers. Is GST applicable on this? No. GST is not applicable on this. Reason being is that this particular notice pay clause or penalty which is mentioned in the employment contract, it is not the object of the employment contract. It is only there as to dissuade, to discourage the employees, non-serious employees to join the particular workforce. This is not as that कि हम बैठे हुए यहाँ पर and I am waiting, oh अच्छा, I want to earn from this. This is the object of my clause. No, this is just a clause which he has violated. So it is a mere flow of money. It is not a consideration. If the company is getting something, what is the employee getting? Employee is getting nothing. There is only one way traffic. Employee is giving to the company. What is company giving to the employee? Nothing. Where is the consideration? So as per this circular, it says any notice pay which is collected by the company, no GST, extremely important. In other income, I will have notice pay, income. You will say, no, sir, GST is there, sir, this circular. It's not there. Expenses, sir, reimbursements. What do we know about reimbursements? Let us. Reimbursements. Let us take an example of reimbursement. Sir, I am a chartered accountant. My professional fees is 5,000 rupees to make a company for you. but 500 rupees I have to pay challan to the MCA portal to formate a company. 5,500 I charge from you. GST will be on 5,000, professional fees on 5,500 total, including challan fees also. Can I get more response? On 5,000, which is my professional fees, or on the amount which is I am paying to the government on your behalf, challan fees on 5,500. What? It will be on 5,000, but there are certain conditions. What is the condition? First condition, I will have to act as a pure agent, concept called pure agent under Rule 33 of CGST rules, extremely important. So what is pure agent? Pure agent is when I am giving a principal supply and not just a supply of 500 rupees, principal supply, formation of company. Pure agent is when I am not availing this service for myself. I am just doing it on your behalf. Third thing, I have an explicit contract and an understanding with you, written contract, that I am going to expend some amount of challan fees on your behalf and I am not going to avail the benefit of that. Fourth condition, pure agent, in my invoice, how much will I charge? 5,000 or 5,500? I have paid 5,500 out of my pocket. How much will I charge? 5,000 or 5,500? I will charge 5,500. Now 500 I will not charge. What? It will go out of my pocket loss. I will charge 5,500. But what will I show? Against 500 rupees I will show paid as a pure agent under section 30, rule 33 and 5,000 professional fees, GST on 5,000. But I have to specifically mention in the invoice paid as a pure agent. So those are called reimbursements. Reimbursements. I have paid challan fees 500 rupees out of my pocket. So I am being reimbursed 500 rupees from my client. So on that reimbursement, if I am paying as a pure agent, satisfying these conditions under Rule 33, no reimbursement cost is to be included in value of supply under section 15. Only on 5,000 benefit is there. But how many people in the industry follow this? They have a contract. They mention in their invoice specifically as a pure agent. If you don't have a contract, if you don't have in the invoice mentioned as a pure agent under Rule 33, the department such as yourself, the officers can nab the taxpayers and can say, no sir, where is you are not acting as a pure agent, pay on 5,500. These are compliances which need to be followed, rules. There is one more circular which had come out. Sir, electricity. I am staying in a cooperative society. As we stay, our parents stay, our families stay. We have to pay what? Electricity bill. So there is a meter, sub-meter in front of my gate door. Right? In that sub-meter recording is 500 units. 1 unit is 5 rupees. 2,500 rupees I need to pay for that month. Fine. I get a bill from the landlord, 2,500 rupees. So what is he doing? He has paid 2,500 initially to what? The electricity board, and he is being reimbursed by you 2,500 rupees. Exact actual cost of his. In that particular case, when he gives that invoice to you of 2,500, does he have to charge GST on that? No, he's just being reimbursed. It is actual cost. Had he charged 2,600 from you, whether GST would have been applicable? Yes, GST would have been applicable on entire 2,600 because there is a profit element to that. So this is defined, described as per the circular. Binding on us, sir. This circular came out like 6-7 months ago only. So profit on sale of mutual fund. This is an extract from the PL account. Right? Profit on sale of mutual fund. Sir, any GST is applicable on this? Mutual fund is a stock. No GST. This is a non-GST supply. When we see this, what do we see? First is income tax refund. These are all other income. Income tax refund, any GST? No. How is it a statutory refund, right? No GST. Rental income. GST is there or not? GST is there obviously on rental income. If my rental income total is more than 20 lakh rupees in a year, I have to file for a GST registration within 30 days. If it is 10 lakh rupees, I am not required to be registered under GST. Foreign exchange fluctuation, no GST. Dividend income, on dividend income any GST applicability? No. It is a non-GST supply. Dividend income, no GST applicability. Interest income on fixed deposit with bank. Fixed deposit interest I am earning. Specifically exempt. 27A, 122A of master notification 12/2017. But this will be added to my annual aggregate turnover threshold limit, right? Profit on sale or disposal of fixed asset. We discussed right now 5 years, 60 months or quarter, 20 quarters. We need to evaluate that. Profit on sale of mutual fund. No, mutual fund stock shares, they are not any elements on which GST is charged. They are neither goods, they are neither services under GST Act, right? So when we see all of this, these questions come to our mind, right? What is the value of the transactions, whether it is an exempt sale, now whether I need to reverse, if I am saying it is an exempt supply, profit on sale of mutual fund. Profit on sale of mutual fund, is it an exempt supply? It is a non-GST supply. Shares and stock, they are not either goods or services. So here, circular number 196, what does it say? Share, security, third line are neither goods or services. Non-GST supply, not even an exempt supply. If it is not an exempt supply, what will not happen? Reversal of common input tax credit under 42, 43. That will not happen. Now, can I claim input tax credit on demat charges? Can I claim input tax credit on brokerage? Can I claim input tax credit on specific expenses for the sale of mutual fund? No, because it is a non-GST supply. So how can I claim input regarding that? Sir, insurance claimed. This is from my profit and loss account. I have received insurance. My entire factory burned. 1 crore rupees of stock all burned, destroyed or stolen. Chori ho gaya. So I have a stock insurance. I get 90 lakhs against my stock insurance. Here 90 lakh rupees I get. Miscellaneous income. Sir, GST is there on 90 lakhs or not? Or any applicability of reversal of input tax credit on the stock which is lost or stolen, burned. Section 17 subsection 5 clause H. What does it say? Any stock which is stolen, destroyed, any stock which is written off, input tax credit needs to be reversed. Try to understand what is stock. It is an element of sale. Am I selling it? So government is getting revenue. So I have claimed input tax credit, I will avail it against any other sale. Am I allowed to do that? Or that particular stock is not giving any output tax, I have booked input tax credit on purchase or on making it, and then I set off that input tax credit against some other sale. So there is a loss to the government, huge loss to the government. Entire amount of abnormal loss, input tax credit in respect of the 1 crore rupees, 18 lakh rupees, entire have to reverse. So whenever you see some insurance claim coming in PL account, other income, first thing should come to our mind should be, oh, acha, any reversal has happened or what? Stock has been burnt, stolen. Acha, let me see whether I will see the tax ledger. No reversal, I will charge reversal with interest right now. Because this is the law. This I have already discussed. Processing charges. Now if I see in my PL account processing charges 594.16. This is a huge processing charges in millions, means 59 crores of processing charges. What triggers in my mind? Job working. I have given goods for job working. These are my job working charges, processing charges. So sir, job working is there. Have I filed ITC 04? Are we aware what is ITC 04? ITC 04 is a statement wherein we have to report if I have a turnover of less than 5 crores 2 times in a year after the end of the half year. Means for 1st of April to your 30th of September, on 25th of October, I have to file ITC 04. What do I need to mention? I need to mention the names and the whatever the delivery challan numbers of all the stock which I have sent to my job worker, and the stock which has come back from the job worker, the delivery challan number and the date I have to mention. Why do we need to do all this? The government needs to keep a track. What? That the input which you have sent for job working, whether it is returned back within 1 year from the date of sending. All of us, we are aware, right? If it is not returned back within 1 year from the job worker, then it is a deemed sale. The principal has to issue a tax invoice when? Back in the day, 1 year earlier. He has to pay interest of 1 year. Huge penalty. Huge interest. So they need to keep a track, the government, ITC 04, whether goods have come back or not. So if there are processing charges, we need to see job working, goods have gone, goods have come back. Okay, whether job worker has sold goods from there only. Job worker can sell from there. I am sending it to Jharkhand to my job worker. Customer is there in Jharkhand. He will send it back to me, then I will send it to the customer. No, job worker will sell it from there. So what is the compliance for there? The job worker has my stock, my ownership with him, and he is selling it off. Is it possible? If I authorize him to do so, and if his place of business is registered as my additional place of business, then he can sell off from there on my behalf. If there is any scrap or sale, scrap while doing job working in the premise of the job worker, whether that scrap has been sold off by the job worker or not, it can be sold off by the job worker, no problem. Has that been recorded here? Has GST been charged on that? Capital goods, if I have given for him to oil, to fabricate, to do all of that, within 3 years has it come back? If it has not come back, then GST needs to be charged on the same as deemed sale. All of these questions will come. This is a trial balance. If we see in the trial balance, consumption of raw material, cost of material consumed, all of these things, what does this mean? We need to evaluate whether the goods have been returned, defective goods, if it has been returned by my customer, whether I have issued credit note. Let me ask you a question. By when can I issue a credit note which has a GST downward taxability adjustment benefit in my books? For example, I made a sale in May 2024. Goods were returned by the customer when? Say March 2025. Now I have to issue a credit note to the particular buyer. By when can I issue a credit note? GST credit note. Exactly. Under Rule 34, I can issue it up to 30th of November 2025. Why? What does this mean? This means I will get the benefit of lowering my taxes of March 2025 of the amount of tax which I have already paid earlier, against which I am issuing the credit note. Means I am reducing the sale. So that benefit I will only get if I issue a credit note under Section 34 up to 30th of November. Whether I have done that or not. After 30th of November, can I issue some credit note? Can I issue any credit note after 30th of November? Any credit note, not GST credit note, any credit note. Yes, I can. 10 years later also I can issue financial credit note, accounting credit note. What does this mean? This means that I am going to issue a credit note of 100 rupees. Tax will be 18 rupees. Or I will issue of 118 rupees full. But I will not get the benefit of downward adjusting that 18 rupees in my GST R1 and 3B. But I can still issue that credit note. Why? So as to tally my account in the books of the buyer, and in my books the account of the buyer. I will tally the balance. So I can issue the credit note later on also. That's no issue regarding that.